Thanks a lot, Rishabh. Yeah,
Yeah, so yeah, we are live, sir. We can
yeah,
start.
thank you. Thank you. So, hello everyone. So, again, we came up with a live session that is our master class where I will be teaching you the concepts related to finance, right? So, I already took several sessions on finance and I have discussed about financial management. I have discussed the introduction part of financial management in my previous lectures. And after that, I have discussed about time value of money concept. I have discussed about role of CFOs. These all things what I have done, I have discussed till now, right? Now what I will be doing, I will be starting very important concept right now, right? That is cost of capital. है ना? So in practical life, when you will be joining for any analyst profile, right? So most of the time, what you will be doing, you will try to find out the cost of capital, right? This is the very important thing, and this concept will be applicable everywhere, right? If you are planning to choose finance as a career, so this concept will be applicable everywhere, right? So these things what I will be doing, I will be discussing in detail with you, and I will be telling you that how you can find out the cost of capital, right? So the very first thing which I will be teaching you here, that is what is capital. First I will be giving you the idea of capital, and I think you all know about capital, that what actually is capital, right? But still what I will be doing, I will be giving you the idea, and then we will be continuing with the cost part, right? So just a moment, I will be sharing the file with you. Okay, so if you see now, we will learn a lot about cost of capital. First, I will be telling you that what is capital, right? So whenever you start a business now, what you try to do, you try to raise lots of capital for your business. Why I'm saying that you try to raise lots of capital for your business, right? Capital means money which is required to run a business, है ना? So let's suppose you are starting any kind of business. You are planning to start a restaurant business, है ना? You are planning to start a restaurant business. I take small cases so it will give you better understanding. Or you might have seen the episodes of Shark Tank, right? In Shark Tank, usually what pitchers they do, they uh, present their business idea and they try to raise money from sharks, right? So I think you might know Ashneer, you might know Aman, you might be knowing Anita, right? Vinita. So there were several investors who have participated into Shark Tank, and they have invested into several businesses, right? So when you start any business now, what do? You raise money, right? So how you can bring money to your business? So what you can do, you can invest your own capital, right? Own capital means you can invest money from your own pocket, right? Otherwise what you can do, you can borrow loan from banks, right? This is going to be the another source, right? Once your company will be matured or you are having great business ideas, so what you can do, you can attract investors, right? You can raise money from investors also, right? Or once your company is old company and your company is a company who is doing well, pretty well, right? Then what you can do, you can raise money by issuing shares to the public, Hana, that is also known as IPO, right? Now IPO is a trending topic everywhere nowadays, right? Most of the companies, what they are doing, they are trying to raise money by taking money from public, that is also known as initial public offer, right? Now if you see here, so what you will be doing, you will be raising money from your own pocket. First investment should be from your side, right? So this is going to be your own capital. So usually when you start a new business now, you can't go for IPOs, right? You can't directly demand money from public, right? There is a norm provided by SEBI which you have to fulfill before you raise money from public or investors, right, via IPO, right? So there are several norms, that your company should be old company, at least 10 to 15 years, right? Your company should be a profitable company. Nowadays, SEBI allows for IPO to loss-making company also. You can see the example of Zomato, but there are different norms, right? Your company should be profitable company, right? Your company should have a good sales record, and there are several other conditions. Via, if you want to issue IPO, so you have to follow these conditions, right? Now, if I talk about investors, so if you are having great idea, what you can do, you can attract investors anytime, right? Even though if you have not started business, but you are having idea with you, you need money. So what you can do, you can pitch your idea to the investors, and definitely they will be investing into your business, right? So if I take example of Oyo, right? Oyo, initially when Ritesh Agrawal, he was planning to start his business, he was not having enough money with him, right? So what he has done, he has attracted different investors, and investors, they really like the idea of Ritesh Agrawal, and they have invested into their business. Same with Zomato, same with every startup. You will find this thing in every startup, that there are some investors who have invested into startups, and those startups nowadays they are booming, right? So you can see all these cases, and I think you might have seen several cases in Shark Tank also, right? Now, when you are raising money, right? When you are raising money, when your business is raising money, so definitely what you need to do, you need to pay some amount to the investors, to the lenders, right? Etc. Etc. So now let's suppose what you are doing. I think you might be knowing separate legal entity concept, right? Business and owner, they are different persons, right? You might be knowing separate legal entity concept. There's a term in accounting that is legal entity concept, or you can also say separate legal entity concept, right? So here what separate legal entity concept says, that owner and business, they are two different person, or two distinct person, you can say, huh? So let's suppose you are starting a restaurant business, right? Now your restaurant will perform the sales, right? Definitely you are the owner, but here restaurant is a separate entity and you are a separate person. Two entities, sorry, in the owner and your business is a distinct person, right? Now what restaurant will be doing, restaurant will be performing the sales, and restaurant will be receiving the cash, है ना? And your restaurant will earn the profit, है ना? Here you can't say that I am earning the profit. What you will be saying, you are starting a restaurant business, so you will say that my restaurant is performing sales of 10 crore in a year, right? You will say that my restaurant is earning profit of 2 crore in a year. You can't say that you are earning profit. You will say your restaurant is giving you profit of 2 crore rupees in a year, right? Now definitely what you will be doing, if your restaurant is earning profit, so definitely what you will do, you will withdraw some money from your restaurant, for your own expenses. So when shareholders, because right now you, let's suppose you have not raised money from public, and let's suppose you are a 50% shareholder, right? What you have done, you have approached some investors. So what investor they have done, they have invested, let's suppose 5 crore into your restaurant business, and you have invested 5 crore rupees into your restaurant business, huh? You both have invested, right? Now 50% ownership belongs to whom? 50% ownership belongs to investor, and 50% ownership belongs to you, right? And if your business is earning profit of 2 crore rupees, so what business will be doing, what restaurant will be doing, restaurant will be giving you 1 crore rupees profit, because you are 50% stakeholder of this profit, and to investor your business will be giving remaining 1 crore, because your investor, he is holding 50% shares into this restaurant business, right? So this is the process. Now if I talk about cost for company, so cost for company is going to be how much? To you, company is paying 1 crore, so this is the cost for company. Company is making profit of 2 crore, and once company has made profit of 2 crore, company is giving you 1 crore rupees. So this is a cost for company, right? This is a cost for company. Company is giving 1 crore rupees to investor, right? So this is a cost for company, right? Now what we have to do, we have to find out the cost of capital, right? That how much cost company is bearing, right? When you will be joining as a finance profile position into any company, so what company will ask you, company will ask you to find out the cost of capital, and what company will say that how to reduce this particular cost, huh? Your responsibility will not be that you only have to find out the cost. There will be several other responsibilities which you have to fulfill. You have to suggest the company that how they can reduce the cost. If they will be reducing the cost, so definitely their profits will increase, right? So that is the reason what company will be doing here. Company will be asking you to reduce the cost. So if you are having good understanding of this chapter, so definitely you will be able to reduce the cost of company, and you can perform well into any company, right? So again, I'm taking example what you are doing. You are starting a business, and how you have raised money to start this particular business, right? So first what you have done, you have asked investors, right? What investors are doing, investors, you can say shareholders, right? Investors, they took some equity, right? They investors, they some equity, took some equity, and they have invested into your business, huh? So let's suppose what you have done, you have raised 100 lakh rupees from investors, right? After that what you have done, you have approached bank also. What bank is doing, bank has also invested 50 lakh rupees into your business. It is not going to be invested. We can say bank has landed 50 lakh rupees into your business, right? Apart from bank, what you have done, you have issued preference shares also, right? You have issued preference shares. If you don't know about preference shares, so we will be discussing about preference shares in detail in coming lecture. Now, preference shares, they have invested 50 lakh rupees into your business. Now, you just let me know what money or what compensation you will be giving to equity shareholders. So you will say, sir, to equity shareholders, what we will be doing, we will be giving dividend. Definitely, you will be giving the dividend, right? To bank, what you will be doing, you will be giving interest, right? Because you took 50 lakh rupees cash from bank, so definitely you have to pay interest to banks, right? To preference shareholders, what you will be doing, you will be giving them dividend, but it is going to be preference dividend. It is going to be pakke pakke se preference dividend, right? So this is going to be the cost. This is going to be the cost. So to equity shareholders, what we do, we give them equity dividend, right? And to bank, we give them interest, right? And to preference shareholders, we give them preference dividend, right? Now I will write down the numbers here, and then we will learn how to calculate cost of capital, right? So to equity shareholders, what you are doing, let's suppose you are paying a dividend of 15 lakh rupees, right? You are paying dividend of 15 lakh rupees. To bank, you are paying interest of 10 lakh rupees, right? And to preference shares, you are paying dividend of let's suppose 6 lakh rupees, right? You are paying dividend of 6 lakh rupees, right? Now what you have done, for you have raised 100 lakh rupees from equity shareholders, and for this 100 lakh rupees, what you are doing, you are paying dividend of 15 lakh rupees. So how much you have raised? You have raised 100 lakh rupees. So this much money you have raised from equity shareholders, and for that 100 lakh rupees, you are bearing cost of 15 lakh. So this is going to be the cost for equity shares. Yes or no? Yeah, definitely it is going to be cost for equity shares, right? From bank, what you have done, you have borrowed 50 lakh rupees, and for this 50 lakh rupees, what you are doing, you are bearing cost of 10 lakh rupees, right? So this is going to be cost of debt, right? This is going to be cost of debt. Right here, I will write down cost of equity shares, and this is going to be cost of debt. Right? You have raised 50 lakh rupees from equity preference shareholders, and you are bearing cost of 6 lakh rupees. So this is going to be the cost of preference shares. But if I ask you to calculate overall cost, right? In detail, we will be learning that how to calculate the cost, right? We will be learning in detail. But right now, if I ask you to calculate overall cost, so how you will be calculating the overall cost, right? This topic we will be covering in detail. We will be covering in detail, and this also we will be covering in detail, right? But if I ask you to calculate the overall cost, so how you will be calculating the overall cost, right? So if I ask you to calculate overall cost, here we know that 15 lakh, 10 lakh, and 6 lakh, if I sum up these values, so this is going to be overall cost, right? But if I ask you to calculate the cost in terms of percentage, right? Wherever you will be joining any company, so they will ask you that what is the percentage of cost which company is bearing for their capital. So now what you have to do, you have to calculate weighted average cost of capital. Okay, there is a method that is weighted average cost of capital to calculate overall cost, weighted average cost of capital, right? Which is also known as overall cost of capital, which is also known as overall weighted average cost of capital, and we also say it as the WACC, right? The full form I have already written here. That is weighted average cost of capital, right? Now, I will be writing down the format, so you will be getting the better idea so that how to calculate weighted average cost of capital. So here, if I write down, first I will be writing down the security, right? First I will be writing down the name of security. So first security is equity shares. Second is debt, or you can say bank, right? We have borrowed debt, and third is preference shares. Third is preference shares. Now what I will do here, I will write down the amount, right? So from equity shares, how much you have raised? You have raised 100 lakh. From debt, you have raised 50 lakh. And from preference shares, you have raised 50 lakh, right? Now, if you see, if I talk about the weight, first we have to understand the weight concept, because we are using weighted average cost of capital. So we have to find out the weight of total capital, right? So if I calculate here the weight, so what is the weight here? What is the weight? If you see, if I talk about the weight, so weight is how much? Total capital is of 200 lakh rupees. Total capital is of 200 lakh rupees. Right here, if you see, total capital is of 200 lakh rupees. Right? If I ask that what is the weight of equity shares as compared to total capital? So equity share amount is 100 lakh and total capital is 200 lakh. Right? Total capital is how much? it is 200 lakh. So if I ask you that what is the percentage of weight of equity share capital, so definitely you say that sir 100 lakh is 50% of 200 lakh, right? So we can say it is 50% weight of equity share is 50%. Instead of 50%, what I will do, I will write down 0.50. I will be writing the figures in decimal. If I ask you that what is the weight of debt as compared to total capital is 200 lakh and debt weight is how much? 50 lakh. So it is 25%, or you can write down 0.25. Here also it is 25%, you can write down 0.25, right? So we have calculated the weight. Now, if I ask you for 100 lakh rupees capital, what we are doing, we are paying 15 lakh rupees dividend. If I ask you to calculate in terms of percentage, that what percentage of cost company is bearing for equity shareholders. So you will say, sir, 15 lakh company is paying dividend and total capital which has been raised by company is 100 lakh. So company is paying 15% dividend. In terms of percentage, if I ask you to calculate, so you will say that sir, company is paying 15% dividend, right? If I talk about debt, so company has raised 50 lakh rupees and for 50 lakh company is paying 10 lakh rupees interest, right? Company is paying how much interest? 10 lakh rupees interest company is paying here, right? So what is the cost of debt here? So here company is paying 10 lakh debt for 50 lakh rupees. Instead of 10 lakh, you know what I should do? I should take here 5 lakh. I will be taking here 5 lakh, right? I will be taking here 5 lakh, right? So company is paying interest how much? That is 5 lakh, right? So here if you see interest cost is how much? It is 5 lakh and total capital is of 50 lakh. So here company is paying 10% interest to banks, right? If I talk about preference shares, so how much dividend company is paying to preference shareholder? Company is paying dividend of 6 lakh rupees and 50 lakh is the total capital, right? So here if I calculate in terms of percentage, so company is paying dividend of 12%, right? Now next thing which I have to write here is cost, right? I have to write here cost in terms of percentage. Right. So what is the cost of equity share? Cost of equity share is 15%. Right. Cost of debt is 10% and cost of preference share is 12%. Right. This is the step which we have to follow. Right. Now what I have to do, I have to calculate weighted average cost of capital. Right. What I will be doing, I will be multiplying the weight with cost. I will be multiplying the weight with cost, right? So if you see weight is already given here, right? Cost is also given. So simply what I have to do, I have to multiply these two values and I will be getting the answer, right? Process is very simple. So if you see 0.5 into 15%, if I do, so here I will be getting the number that is 7.5%. What I'm doing, I'm multiplying 0.5 with 15% and I will be getting here 7.5%, right? 0.25 into 10% if I do, so that is going to be 2.5 percentage, right? Then 0.25 into 12% if I do, so that is going to be one fourth. It is going to be 3%. Right, so if you see here, so what is the total cost of capital? 7.5 plus 2.5, it is 10 and plus 3. So overall cost of capital is how much? It is 13%, right? So for equity share, for debt, for preference share, if I combine all the cost on the basis of WACC, so here if you see, the overall cost of capital of company is how much? It is 13 percentage. The overall cost of capital is how much? It is 13 percentage. Are you able to understand? This is the overall cost of capital. Now, individually, what we have to do here in this chapter, we will be learning how to calculate cost of equity shares, or we will be learning how to calculate cost of bank, right? Cost of debt, or we will be learning how to calculate cost of preference shares. These all things, what I will be doing, I will be learning, I will be teaching you in detail. Right. So if you see, we learn that how to calculate weighted average cost of capital. Now, in time value of money chapter, we have seen that what we do in time value of money chapter, we have learned that we regularly calculate future value and present value, right? And to calculate future value and present value, we require one discounting rate, right? We require one discounting rate. So we have seen that with the help of discounting rate, what we do, we calculate present value and future value, right? Now, what's that rate? This rate is known as weighted average cost of capital, right? So now if you want to calculate present value or future value, right? So you should have the knowledge of weighted average cost of capital, right? Pakke se you should have the knowledge of weighted average cost of capital. Then you will be able to calculate future value or present value of any organization, right? So you can see the importance of WACC everywhere. right? If you know the WACC, so you will be able to calculate several things, right? So that is the reason WACC is very important concept, and you should have great understanding of WACC, right? Now, if you see, so how you will be calculating the WACC? For calculation of WACC, you should know the cost of individual capital, like cost of equity shares individually. You should know the cost of debt individually. You should know the cost of preference shares individually, right? Now you might be thinking, sir, you might be thinking that, sir, how it is difficult to calculate cost of equity share, or how it is difficult to calculate cost of debt, or how it is difficult to calculate cost of preference shares, right? Now just think, if I talk about debt, right? In case of debt, it is easy to find out the cost, right? Because you will be having the data that company has borrowed. Let's suppose I'm taking the example of debt here, right? How you will be calculating the cost of debt? Company is borrowing loan from bank, right? Company is borrowing some loan from bank. Now, it is easy to find out cost of debt, cost of preference shares, but you will be facing problem at the time of cost of equity shares. How you will be calculating the cost of equity shares, right? This thing we have to understand in detail. So I will be giving you the idea. Don't worry. Let's suppose you are a company, right? Let's suppose you are a company, right? What you are doing, you are borrowing loan of 500 lakh rupees from bank, right? Now, what bank is saying that bank will be charging 10% interest every year from your company, right? Bank is saying bank will be charging 10% interest every year from your company, right? So bank will be charging 10% interest, and bank has borrowed 500 lakh rupees from you, right? So you will say that, sir, cost is 10%. Obviously, yeah, that is absolutely correct, but in case of debt, there is one point which you have to remember always, right? So I am marking this point important and writing down a note also here. I'm marking this point very important and writing down the note here, right? What is the note here? What you have to keep in your brain, right? That in case of interest payment, in case of interest payment, business receives tax benefit. In case of interest payment, business receives tax benefit. Now, what is the meaning of tax benefit? In case of interest payment, business receives tax benefit. Why I'm saying this right here, right? Whenever you prepare P&L account, so what format you use, right? So let's suppose I'm preparing here P&L account, and I will be showing you the format. I will be showing you the format of P&L account. Just see this thing very carefully. I'm writing down the sales here. First, you will be writing down the sales, right? You will write down the sales. Let's suppose sales is of 10,000 crore rupees, right? After that, you will write down the cost, right? Cost of raw material, right? Let's suppose cost of raw material is 5,000, right? Then you will write down the other expenses. Let's suppose you are paying salary. Your company is paying salary of 1,000 crore. You are incurring some other expenses, right? Let's suppose other expenses is of rupees 1,000 crore, right? And your company is also paying interest on loan, right? Interest on loan your company is paying. How much interest company is paying? Let's suppose company is paying interest of 2,000 crore, right? Now, if you see here, so what is going to be your profit before tax? So your PBT is going to be, your total sales is of 10,000 crore, and you are bearing some other expenses. So your PBT is going to be 1,000 crore, right? Now here, what you will be doing, you will be paying tax to the government because your profit is 1,000 crore. So you will be paying tax at the rate of 30%. So you will be paying tax of 300 crore rupees to government, right? And what is going to be your profit after tax? Your PAT is going to be 700 crore rupees. This is going to be your PAT. After that, what you will be doing, you will be paying preference dividend, right? You will be paying preference dividend. After that, you will be paying preference dividend. So let's suppose what company has done. Company has raised 2,000 crore rupees from preference shareholders by issuing preference shares. Company has raised 2,000 crore rupees, and company has promised company will be paying preference dividend of 10%. Right? Company has promised that company will be paying preference dividend of 10%. Right? So company has raised total 2,000 crore, and company will be paying preference dividend of 10%. So 10% of 2,000 crore is going to be how much? It is going to be 200 crore. Now remaining profit belongs to whom? Remaining profit belongs to equity shareholders, right? So remaining 500 crore will go in the pocket of equity shareholders, right? This is how we prepare a financial statement, right? Now, if you see here, what I'm trying to make you understand, you have to see this thing very carefully, right? This is important concept which you have to learn here, right? Now, what I'm trying to make you understand, just say here, what company is doing? Company is paying interest. है ना? Company is paying interest. How much? Company is paying interest of 2000 crore. Right? After that, company has calculated profit before tax and company is paying tax. Right? Company is paying tax, and whatever amount is remaining after payment of tax, company is distributing between preference shareholders and equity shareholders. Right? This is the concept which you have already learned in your schools or colleges. Right? Now, further, what I'm assuming here, I'm preparing one same P&L account I will be preparing, and I will be assuming that company is not paying any interest. Now you will get the idea, right? Sales is of 10,000 crore. I will be taking the same numbers. Raw material 5,000 crore, salary 1,000, other expenses 1,000, and here company is not paying any interest, ignored interest. What is going to be here? Profit before tax. So profit before tax is going to be 3,000 crore. Now, how much tax company will be paying here? 30% of 3,000 crore is going to be 900 crore, right? It is going to be 900, and balance profit will be distributed between preference shareholders and equity shareholders, right? So, to preference shareholders, how much profit company has to give? For preference shareholder, profit will be fixed 200, and remaining profit will be distributed to equity shareholders, right? Now, if you see here, if company is not paying interest, so how much tax company has paid? Company has paid tax of 900 crore rupees. If company is paying interest, company has paid tax of 300 crore rupees. You can simple understand the logic. Simply, you will be able to understand that if company is paying interest, so company is paying less tax. How much less tax company is paying? Company is paying 600 crore rupees less tax here, right? If company is paying interest, so company is paying 600 crore rupees additional tax, right? Company is paying 600 crore rupees additional tax, right? Now you just try to understand that if company is paying interest, so company is able to save their tax. How much tax company is able to save? Company is able to save 600 crore rupees tax, right? Company is able to save 600 crore rupees tax here. Now if I ask you that what tax saving company is able to do, company is able to save tax of 600 crore rupees, right? Why? Because company is paying interest, right? So when company is paying interest of 2000 crores, company is able to save tax of 600 crore. So if I ask you that what is going to be the net cost, so net cost of interest is going to be 1400 crore rupees. Net cost is going to be how much? 1400 crore rupees. This is going to be the net cost, right? So indirectly I can say that just because company is paying interest, company is able to save tax, right? So whenever you will be calculating the cost of that, you have to take net cost. You don't have to take full cost, you have to take net cost, and this concept you have to remember always, right? Because indirectly company has to pay net interest, that is 1400. Actually company will be paying 2000 crore rupees, but company is able to save tax, and we always consider net cost as a uh, interest for calculation of cost of debt, right? So here there is a shortcut formula. I will write down the shortcut formula also. Shortcut formula for calculation of interest cost, right? So how you will be calculating the interest cost? So there is a formula. I will write down the formula and I will solve this case also. So formula is interest 1 minus tax, right? If I solve this case, so interest is how much? Interest is 2000 crore, right? 1 minus tax. Tax is how much? It is 30%, right? So 30% को हम लोग ऐसे लिख सकते हैं 0.30 if I write in decimals. So it will be 0.30, right? It will be 0.30. So 2000 into 0.70, right? And here net cost is going to be 1400 crores. This is going to be the net cost, right? So whenever you will be calculating the cost of debt, here what you have to do, you have to calculate net cost, right? So let's suppose here in this case, company has to pay tax. How much? Company has to pay tax of 30%, right? In this case, company has to pay tax of 30%. So what is going to be the net cost? Here company is paying interest of 10%, right? So if I calculate the interest in terms of rupees, so interest is going to be how much? 10% of 50 lakh, 500 lakh, sorry, it is going to be 50 lakh. Now if I calculate net interest, so same formula I have to use. Which formula? That is interest 1 minus tax, right? So what is the interest amount? Interest amount is 50 lakh, right? 1 minus tax, so 30% we can write like this, 0.30, and 50 lakh into 0.70 if I do, so interest cost is going to be 35 lakh, right? Now if I calculate cost of interest or cost of debt, so here formula is going to be interest divided by net proceed. What is the meaning of net proceed? Net proceed means what amount you are receiving when you are issuing debt, when you are taking debt from banks. So you have received 500 lakh rupees, and how much interest you are paying? You are paying 35 lakh. Right? So if you see, so here answer is going to be 35 lakh divided by 500 lakh, so into 100, or you don't want to multiply it by 100, that is okay. So this is going to be 7%. So your net cost is going to be how much? 7%. And what is your actual interest cost? It is 10%. So this is the difference which you have to keep always in your mind when you are learning this particular thing, right? So I will be taking remaining cases in next master class. So stay tuned with us for more and better